What if inflation, Bitcoin, stocks, gold, housing, interest rates, and even artificial intelligence weren't separate stories, but pieces of the same code? That's exactly what macro investor Raoul Pal believes. While most analysts spend their time explaining individual events, why stocks fell today, why Bitcoin rallied this week, or why the Federal Reserve made its latest decision, Pal argues they're missing the bigger picture. According to him, nearly every major financial trend can be explained through one interconnected framework that he calls the Everything Code. It's an ambitious idea. Some supporters believe it could become one of the most important macro investing frameworks of the next decade. Critics argue it's simply a new name for concepts macro investors have discussed for years. Either way, the theory has started attracting attention among investors who want to understand not just where markets are going, but why they move in the first place. So what exactly is the Everything Code? And why does Raoul Pal think it explains almost everything happening in today's global economy? Let's break it down. Who is Raoul Pal? Raoul Pal is a former hedge fund manager and the founder of Real Vision, a financial media platform known for in-depth interviews with economists, investors, and market experts. Over the years, he's become one of the most influential voices in macro investing, particularly among cryptocurrency investors. Unlike traditional stock analysts who focus on company earnings, Pal spends most of his time studying the global economy. He looks at central banks, interest rates, liquidity, debt cycles, currency markets, demographics, technology. His goal isn't simply predicting tomorrow's stock prices. It's understanding the forces driving the entire financial system. The Everything Code is his attempt to connect all of those forces into one coherent framework. Why most market analysis falls short-turn on any financial news channel, and you'll hear dozens of explanations for market moves. Stocks are down because of inflation. Bitcoin is rising because institutions are buying. Gold is climbing because investors fear a recession. Housing is slowing because mortgage rates have increased. Each explanation might be true, but Pal argues they're all describing symptoms rather than the underlying cause. He believes many of these events originate from the same handful of macroeconomic drivers. If you understand those drivers, you don't need separate explanations for every asset class. You already understand the bigger picture. The central idea, liquidity rules everything, at the heart of the Everything Code lies one word: liquidity. Liquidity simply refers to how much money and credit are flowing through the financial system. When liquidity expands, borrowing becomes easier. Businesses invest more. Consumers spend more. Investors become more willing to take risks. Asset prices often rise. When liquidity contracts, the opposite tends to happen. Credit becomes more expensive, spending slows, risk appetite falls, markets become more volatile. According to Pal, liquidity influences almost every major financial asset: stocks, bonds, real estate, commodities, and especially cryptocurrencies. Rather than watching thousands of headlines, he believes investors should pay close attention to global liquidity conditions. Why debt matters so much. Another major pillar of the Everything Code is debt. Governments around the world now carry enormous debt burdens. Corporations have borrowed heavily. Consumers have also accumulated significant debt over decades. High debt changes how economies behave. When debt levels become very large, raising interest rates becomes increasingly painful. Governments pay more to service debt. Businesses face higher financing costs. Consumers reduce spending. Because of this, Pal argues that policymakers often face pressure to eventually ease financial conditions. That expectation influences markets long before central banks actually make policy changes. The business cycle is still alive. The everything code also incorporates the traditional business cycle. Economies naturally move through periods of expansion and contraction. Growth accelerates. Inflation rises. Central banks tighten policy. Growth slows. Eventually, policymakers ease again. The cycle repeats. Pal believes many investors become overly focused on short-term news while ignoring where the economy sits within this larger cycle. Understanding the cycle provides valuable context for interpreting market movements. Technology is changing everything. One feature that distinguishes the everything code from older macro frameworks is its emphasis on technology. Pal believes innovations such as artificial intelligence, robotics, automation, blockchain, and digital payments aren't separate stories. They're deeply connected to macroeconomic trends. Artificial intelligence increases productivity. Higher productivity can offset some inflationary pressures. Digital assets create an entirely new financial infrastructure. Automation changes labor markets. These developments influence economic growth, corporate earnings, and investment opportunities simultaneously. Rather than viewing technology and macroeconomics separately, Pal argues they're becoming increasingly intertwined. Why Bitcoin plays such a big role? Many people associate Raoul Pal with Bitcoin. That's not accidental. Within the everything code, Bitcoin isn't simply another investment. Pal sees it as one of the assets most sensitive to changes in global liquidity. Historically, periods of expanding liquidity have often coincided with strong performance in cryptocurrencies. That doesn't mean Bitcoin rises every time liquidity increases. Markets remain influenced by regulation, adoption, investor sentiment, and unexpected events. But Pal believes liquidity remains the dominant long-term driver. This explains why his macro analysis frequently leads to bullish views on digital assets. It's not just about crypto. One common misconception is that the everything code exists solely to justify bullish Bitcoin predictions. That's too simplistic. Pal applies the framework to equities, bonds, currencies, commodities, and global economic trends. His argument is broader. Different assets respond differently depending on where the economy sits within the liquidity cycle. Some benefit during tightening, others outperform during easing. If you enjoyed this breakdown, like the video, subscribe to the channel, and drop a comment below telling us which macro investing theory or legendary investor you'd like us to explain next. Thanks for watching, and we'll catch you in the next one.